Oh no! Oh no! Oh no! Is the bond market on the verge of a total discombobulation? What does this all mean? Let's find out. What is this article talking about? Let's ask Copilot for a summary. This page talks about economic growth, business spending, recession indicators such as the inverted yield curve, and the stock market implications therein. Alright, so let's talk about it. Recession indicators.
Recession indicators, the bond market and the leading economic index are both signaling a high risk of recession. The yield curve inversion and the decline in the lei have historically preceded recessions with high accuracy, although the timing is uncertain.
But isn't that the whole basis of the federal funds rate? To raise the interest rates, to discourage borrowing and lending in order to cool down the economy. By slowing down the economy, you hence kill inflation by causing a recession. Isn't that the whole basis? I think this whole article is about that. The effect of raising the Fed funds rate with implications of a slowdown. But isn't that the whole point? You fight inflation by creating a recession or a slowdown in the econ. Isn't that the whole point? I don't know, you guys. I'm just a shtickler guy. What the hell do I know? Let's pose another question. What is the current state of affairs? According to the inverted yield curve. What's going on? What's the state of affairs? Let's ask for a more concise question.
I can tell you that as of November 24, 2023, the yield curve is indeed inverted. The yield on a 1-month Treasury bond was 5.411%, while the yield on a 1-year bond was 5.284%. And the yield on a 2-year bond was 4.955%. The yield on a 10-year bond was 4.472%, and the yield on a 30-year bond was 4.603%. This means that shorter-term bonds had higher yields than longer-term bonds, which is characteristic of an inverted yield curve. You can view the current yield curve chart on the Guru Focus website or the Federal Reserve Bank of St. Louis website. Please note that an inverted yield curve has historically been a reliable indicator of an impending economic recession. However, the timing of the recession is uncertain and can vary.
Oy vey, I'm getting scared. Are you getting scared? Are you getting nervous? Oy vey, it's me. So should we sit? Hey, I'm getting discombobulated thinking about it. I'm getting discombobulated thinking about the inverted yield curve. I'm getting discombobulated thinking about it. Alright, so let's pose another very important question. What is a normal yield curve in an healthy economy? If an inverted yield curve is bad, well, what is a good yield curve? That's what we gots to know. We gots to know. We gots to know. Guys, are you getting all of this? Are you getting discombobulated thinking about it like I am? Because I'm getting discombobulated. Play the clip, Johnny.
A normal yield curve, also known as an upward sloping yield curve, is a yield curve in which short-term debt instruments have a lower yield than long-term debt instruments of the same credit quality. This gives the yield curve an upward slope. This is the most often seen yield curve shape, and it's sometimes referred to as the positive yield curve. This type of yield curve is often indicative of a healthy and expanding economy. It indicates that market conditions and the economy as a whole are healthy and functioning normally. A normal yield curve shows an increase in the yields with maturity, which helps investors understand that if they preserve the investment for the longer term, they are likely to reap more profits with time. The normal yield curve is considered normal because the market usually expects more compensation for greater risk. Longer-term bonds are exposed to more risk such as changes in interest rates and an increased exposure to potential defaults. Also, investing money for a long period of time means an investor is unable to use the money in other ways, so the investor is compensated for this through the time value of money component of the yield. In a normal yield curve, the slope will move upward to represent the higher yields often associated with longer-term investments. These higher yields are compensating for the increased risk normally involved in long-term ventures and the lower risks associated with short-term investments. The shape of this curve is referred to as normal, over the additionally applicable term of positive, in that it represents the expected shift in yields as maturity dates extend out in time. It is most commonly associated with positive economic growth.
So it's a question of normal versus abnormal. I don't know about you guys, but I'm getting scared. I'm getting scared. Oy vey is mir. I'm getting scared. It's scary. Bonus section. In my opinion, I think we should take all this with a grain of salt, because after all, it's someone's opinion piece.
Based on the inverted yield curve, there is a significant likelihood of a recession in 2024. The ratio of the 10-year yield to the 2-year yield curves in U.S. Treasuries has been inverted since mid-2022, and an inverted yield curve has historically been a strong indicator a recession is likely. The New York Fed's recession probability model suggests a 56.12% chance of a U.S. recession by September 2024. Another source indicates a 66% chance of a U.S. recession by July 2024. Please note that these are probabilities and actual outcomes may vary. The likelihood of establishing a normal yield curve at this point is uncertain. The Federal Reserve has been consistently raising interest rates to fight high inflation. As of July 2023, interest rates have increased 11 times since March 2022, going from 0.25% to 5.50%. This has resulted in higher short-term Treasury rates, creating a steep inverted yield curve. The inversion of the yield curve has historically been a strong indicator of an impending recession. However, firms like Goldman Sachs have been lowering their forecasts for a recession in the U.S. In its latest economic update, Goldman has cut the chances of the U.S. falling into recession over the next 12 months to 15%. The yield curve could potentially normalize if the Federal Reserve lowers short-term interest rates or if long-term economic growth prospects improve, leading to higher long-term interest rates. However, predicting these changes is complex and depends on a variety of factors, including economic data, monetary policy decisions, and global economic conditions. Therefore, it's difficult to provide a definitive likelihood of the yield curve normalizing at this point. Learn more.